Hello again and welcome to the WSBI ESBG Exchange podcast for the week of 2 December 2019. I'm James Piper, Senior Advisor for Communications at the two associations, with a mission to help savings and retail banks thrive. This is episode 10, the second in a series of podcasts on the ESBG handbook released in November. Like every podcast, we highlight news from the world of savings and retail banks in some 80 countries around the globe, including 26 members in 21 European countries. As I just noted, this week we continue to focus on Europe. The European Commission is now in place. The European Parliament has signed off on the von der Leyen Commission. This new Commission was approved by 461 votes to 157 against, with 89 abstentions. The College of Commissioners took office yesterday, 1 December, for a 5-year term. Notable is that this is the first woman commission president and the largest proportion of female commissioners to date. Change is happening, and in many policy areas. With that in mind, ESBG, the European Savings and Retail Banking Group, has published its handbook that outlines the savings and retail bank story and how to help Europeans prosper in the coming years. Diederik Bruggink joins us today in Studio 4A. Diederik leads our payments efforts here at ESBG and WSBI. He joins us for part 2 of our discussion on the ESBG handbook. You may remember the last podcast featured Sebastian Stodulka, who we hope to have back next week. Diederik, thanks for joining us. Europeans make payments in cutting-edge ways, aided by breakthrough payments, technologies. 21st century banks hold the payments accounts. So, a digital bridge formed by APIs, technology guided by PSD2 rules, helps strengthen and integrate the European single market. But teething pains persist, however, marked by foggy underlying business models across the industry. But beyond APIs, the payments industry supports instant payments at pan-European level, and instant payment solutions exist at domestic level in many countries. But before compelling customer propositions can be developed, there is need for certainty about a sustainable business model for instant payments, as the massive efforts required for innovation and future efficiency gains need to be offset by a proper business case. There is a sense of urgency to develop European payment solutions to remain relevant. We ask that policymakers provide support. So given that setup, I have a few questions for Diederik, and you'll notice that setup was part of our featured text messages that we provided in the Political Morning Exchange a few weeks ago. So Diederik, first talk about an integrated payments market outlined in the ESBG handbook.
Yes, thank you, James. And in the handbook, we cover basically two topics. One is about instant payments, and the second is on the PSD2 part you introduced before. Let's focus on the PSD2 part first. As you might be aware, the Second Payment Services Directive, also known as PSD2, and the related regulatory technical standards, in fact, only spell out high-level principles on what banks should do when it comes to the security, customer security, what type of data need to be provided, and how new entrants, the so-called TPPs or third-party providers, how they need to identify themselves vis-à-vis the banks. And it's a bit confusing, although the regulatory technical standards might sound like it is an actual standard. De facto, it's not. So it means there is no clear guidance on what banks should do in order to be compliant with these particular sets of law. So that also caused some fear at the end of the TPPs, the third-party payment providers, that basically each and individual bank would start to develop its own dedicated interface or API, which of course from a TPP point of view would be very horrible, because in worst case it would have to make 6,000 different connections, because that's more or less, roughly speaking, the number of banks that we have in Europe. But what we notice is that a lot of community initiatives or local initiatives have evolved. Banks started developing APIs jointly. Notorious examples are, for example, the Berlin Group, which is supported by international banks. But also we observe, for example, in France, where most banks group together around a standard that's being developed by STET, the local clearinghouse in France. So there won't be 6,000 different APIs, but there won't also be one API for the whole of Europe either. But life for TPPs would be at least a bit more easier. But another issue there is also that given that there is so much ambiguity in those legal texts, that also the national competent authorities have a bit of difficulties in actually understanding what principles they should apply in assessing whether an API is good or not good enough. Which means that, especially for banks that operate across multiple jurisdictions, and we have some in our membership, that where they use the same API in jurisdiction A, it has been accepted and approved good by the national competent authority, whilst in another jurisdictions it's not. Which is a bit confusing and not how a single market should look like. On top of that, of course, also given the ambiguity, there's also a lot of differences in the interpretation, for example, between TPPs on the one hand and banks on the other hand. Banks are typically sticking to the law and their interpretation on the law, and err on the safe side, also in the interest of consumers by limiting data access only to those pieces of data that, according to the banks, are mandated by the law, whilst the TPPs basically want to have access to all data at all times by all means, which also creates some conflicts. And one of the reasons for banks to stick to those defensive line is also because the current business model for PSD2 access to accounts is not really in favor of banks. Banks have to invest a lot to make those APIs available to ensure customer security and data privacy, whilst there's no proper reward in return. So banks have to invest, but they don't get any money for TPPs, third parties, accessing their systems to suck data out of it and basically monetize that particular data, which is also not an incentive for banks to move forward to that. So from a bank's point of view, a way to overcome all these issues is to basically agree on the one hand, okay, this is the basic services that have been provided for free. Bon. And on top of that, there are definitely some type of premium services that we recognize, and we are willing to share those services or pieces of data with third parties. But for that, we need to have a proper agreement with those parties. Basically, an agreement that's based on mutual benefits. So basically, making sure that both parties, both the banks and the TPPs, have their fair piece of the cake. And of course, having these type of agreements would, in worst case, again, result in a lot of bilateral agreements between TPPs and banks. So that's also not very workable solution. And to that end, we really welcomed, from a bank's point of view, the work that has been undertaken by the ERPB, the Euro Retail Payments Board, that falls under the ECB, the European Central Bank, that started last year, or beginning of this year, in fact, to work on a so-called API access scheme. Basically a set of multilateral agreements to facilitate this access and to have these discussions on premium services. And banks are still committed to continue that work. However, the TPP side of the industry has put that work on a hold. So we're still waiting to what would be a good solution to overcome these challenges there.
So teething pains persist,
Yep.
as I said before. Really interesting. Now, let's switch a little bit here. The ESBG Retail Banking Conference held a few weeks ago looked at the European payment system and its sovereignty, and more specifically, a future modern instant payment system. So tell listeners about the EU Instant Payments Project. Give them a little bit of background and how we approach it.
Yeah, there are a couple of angles to cover here. Indeed, also the second topic that I promised to come back on. Basically, upon a call again from the ERPB, the Euro Retail Payments Board, the banking industry developed a so-called instant payments scheme, basically specifying all the rules and principles banks should comply with in order to be able to process transactions across Europe in euro 24 hours a day, 7 days a week, 365 days a year. Basically ensuring that within 10 seconds a credit transfer arrives from one account to another account, as long as it's in the eurozone or euro area, which is quite an impressive thing to achieve, and also it's demanding or calling to the demands from consumers, basically, who also have the need for speed, not only in their daily life but also for the payments underpinning it. So following this call from the Euro Retail Payments Board, the European Payments Council developed a scheme. In parallel, a lot of clearing and settlement mechanisms have laid the technical foundations for it. And by November 2018, we saw that instant payments went live. Lots of banks supporting it already. And we still see, of course, not all banks have adhered to the scheme as of yet, and not all banks are reachable at this point in time. But we see a good progress, and banks have the vision that at least by 2020, all banks in Europe should be, or at least all bank accounts in Europe should be reachable for those instant payments. So that's more the consumer angle of it. But in parallel, we see also more and more calls from regulators to leverage instant payments more and more. On the one hand, because it's an European invention, by default it would fall under European sovereignty. What the regulators are afraid of is basically the fact. Let's take, for example, if we look at the cards business. A lot of countries in Europe have domestic card schemes which function very well. For example, in Belgium you have Bank Contact, in France you have Carte Bancaire, in Germany you have Girocard. And of course these cards also work at the European scale, but the only reason why these cards work at a pan-European basis is because the interoperability between these card schemes is being ensured by non-European companies. In this particular case, usually it's MasterCard or Visa. And the fact that these companies are not European, and by the way, these companies also process a lot of the domestic card transactions in countries that have abolished their domestic schemes, like for example the Netherlands, Ireland, and what have you, gives fear to the regulators that decisions about European payments are being taken elsewhere. And that's considered as a potential severe risk. Hence also the call from the European regulators to come up with pan-European solutions that specifically address those particular needs.
A follow-up question I have is, why does it matter for ESBG and its members?
Again, ESBG has always been supportive of European payments from the start. You might recall, for those that live for longer, that ESBG, or at least the ESBG member banks, already ensured pan-European interoperability between their own cards via the so-called UV-Serve scheme, well before the Maestro was live in Europe. And besides, we have also observed that ESBG member banks were the first to adhere to the instant payment scheme of the European Payment Council. When SCT Inst went live, SCT Inst is the formal name of instant payments in Europe. ESBG member banks already processed the transactions between themselves, and also when the ECB TIPS target instant payment settlement system went live, also the first transaction on that system was between two ESBG member banks. So for ESBG, we are also following developments. We're happy to support these new type of payments in the form of instant payments. But we have also to take into account, of course, that it has to fit in a complete picture of payment methods that exist already. If you look, for example, at the point of sale, of course, people want to pay there with cards. People even want to pay there with cash. And we also foresee a good future for instant payments there. But in order to make all that happen, it also needs to be clear that a sustainable business model is required to facilitate those transactions to flourish. Because also in a car you need some oil to have the mechanics working properly. So to that end, the ESBG is also calling upon the regulators to provide some good guidance on how such a long-term sustainable business model can be developed that's favorable to all involved in the payments transaction.
Well, thanks for that. So tell us about the yellow box in the ESBG handbook that I mentioned earlier in our interview. How should policymakers act?
Yes, thank you, James. And in fact, this is a good summary also of our discussion, because most of the touch points, most of the points mentioned, we have touched upon before. But in the handbook, we stress a couple of areas that we deem important for the new Commission that has come in, the new MEPs that have come in, to take into account when judging certain pieces of legislation that will come or we will evolve in the field of payments in the broadest sense. First and foremost, let me stress again that ESBG fully supports all the principles underpinning PSD2, the related RTS and GDPR, the data protection regulation. And we consider it key that legislators should take, for example, customer protection into account. It goes without saying that banks, by default, are the custodians of lots of customer data. Examples exist that people can say, based upon on payments data, people can predict whether someone is going to divorce within the next 6 months or not. So from that point of view, it's key that access to those particular pieces of data should be protected and governed properly. So customer protection is not only the fact that the way how to access these accounts in the form of strong customer authentication is being described properly, and not only described but also prescribed, but also the data privacy that comes along with it. So it should be crystal clear what pieces of data third parties or other parties are allowed to access and what pieces of data are not. It should also be crystal clear that consumers who engage with these parties exactly know what they're consenting to when they give those parties access to these pieces of data. Because we also fear there a lot of risks, and I must plead guilty there as well. If I download a piece of software and have to agree with terms and conditions, when you get them presented and you have to hustle to 38 pages of gobbledygook, you just hit the accept button because you want to have the services that you are signing up for. But it should be made crystal clear to consumers that of course, it has certain benefits to use those providers, but they also have to be aware that they're sharing basically good pieces of the data with those parties. And further, we believe also on those pieces there should be fair competition between all parties involved, and of course also banks are in a position to start becoming third parties and start leveraging these type of services. But especially in the PSD context, also there, as stated before, it should be based on mutual benefits, and that the time of free lunches should be over. If parties want to leverage and monetize data that they absorb out of the bank's systems, banks should be fairly rewarded for that. And the same basically also goes for the discussion we just had before on instant payments. Banks are happy to be innovative and to continue to be innovative, but a key requirement is that business models underpinning these type of initiatives should be sustainable in the long term for all involved. I think that's basically summarizes it all. as long as banks cannot make a living out of it. It will really put banks at risk, and then also the consumer data that banks safeguard as the default custodians of it.
Well summarized. Thank you, Diederik, for coming in. We always enjoy getting so much insight from you. So keep up the good work, and thank you very much for your time here today on the podcast.
Thank you very much, James.
Well summarized. Thank you so much, Diederik, for coming in today. For more information about our positions on payments, go to the WSBI ESBG website or check out our ESBG handbook. We look to do another podcast for more talk about the ESBG handbook. Beyond the world of ESBG, WSBI last week published new research on young people in Africa, which was released by the WSBI Scale to Save program. The new Scale to Save research outlines ways to drive financial inclusion by reaching more African youth. The quest to increase financial access in Africa struggles to stay ahead of surging growth in the numbers of young people. So check out this new report on the WSBI ESBG website. In addition, 4 videos on YouTube bring the report to life with first-hand interviews from young people in Senegal. Those videos touch on savings, income, and spending, along with a summary report. Just type in Scale to Save in YouTube search and click on the first video you see. We plan to have our Scale to Save experts in an upcoming podcast later this month. That's it for this podcast for the week of 2 December 2019. Special thanks to our technical ace, Alexander Duchamont, and ESBG expert, Diederik Bruggink. To close, we welcome listeners to learn more about ESBG and the ESBG handbook by going to our website. We also welcome listeners to read about the Retail Banking Conference in the news section of the website. I'm James Piper, signing off until next time. Thanks for listening. For more information about WSBI and ESBG, go to our website. Visit us on YouTube, Twitter, and LinkedIn. The podcasts are available on both SoundCloud and YouTube.